Hello, and welcome to Lesson 10 of the Value Investing Bootcamp. In the previous lesson, we explained the nature of risk on the stock market. Armed with this knowledge, we can now look at ways to minimize downside risk. Because remember what Buffett said. Rule number 1 is never lose money. Rule number 2 is never forget rule number 1. Also, it just makes you sleep better at night. Let's dive in. We learned that risk is the probability of losing a certain amount of money. So to reduce risk, we have to either reduce the probability of a loss or reduce the amount of money we can lose in a worst-case scenario. So what are ways to do this? Well, an often mentioned method of reducing risk is called diversification. Diversification is the practice of spreading the risk over several investments instead of putting all your eggs in one basket. This way, when one stock declines in price, another one of your stocks might go up at the same time, and so on average, you don't lose as much as you would have if you had only owned the stock which declined in price. The effect of diversification is therefore that it averages out your returns, and therefore makes it a smoother ride, because it limits massive fluctuations in portfolio value to a minimum. This sounds like a great strategy to many, because wild swings in portfolio value might make some investors rather uncomfortable. But remember that price swings say little about how well the underlying companies are actually performing. Also, volatility does not equal risk. It merely offers opportunities to buy at lower prices and sell at higher prices. Therefore, reducing short-term volatility makes no sense for the long-term investor. It only creates the illusion of a smoother ride. Besides, if you diversify too much, the average return of your portfolio will be similar to the average return of the overall market. In other words, too much diversification ensures mediocre results at best. It severely limits your upside potential. So is diversification useless? Absolutely not. To a certain extent, diversification is good and can protect you against unexpected, unpredictable events which hit a certain company or industry harder than another one. Legendary author Mark Twain once said, "Put all your eggs in one basket and then watch that basket." While you should spread the risk of your portfolio by purchasing several companies, preferably in different industries, Mark Twain does have a point, because when it comes to diversification, less is often more, for several reasons. First, it is rare to find great companies trading at discount prices, which is what value investors look for. Since it is rare to find such bargains, it is impossible to compose a portfolio of, say, 40 of these great stocks, simply because there aren't that many opportunities out there. In this case, diversification means buying less than great stocks, simply for the sake of diversification. A practice which actually increases the overall risk of your portfolio rather than reduce it. Second, having a long list of stocks in your portfolio makes it harder to stay on top of them all. It makes it harder to know everything there is to know about all of these businesses. A small portfolio is much easier to manage, and you can actually become an expert on each of the companies you own. Third, more companies equals more transaction costs. And transaction costs are the silent killer of portfolio returns. Finally, the more stocks you own, the more your returns tend to converge to the average return of the stock market. This makes it virtually impossible to consistently earn above average returns. So how many stocks should you own? There is no magic number, but I suggest to do what most of the greatest investors in the world do and stick to around 10 great stocks. Besides diversification, there is an even more powerful way to reduce the downside risk of your portfolio. Warren Buffett once called it the 3 most important words in investing. These 3 words are margin of safety. So what does he mean with a margin of safety, and why is it so important? Well, a margin of safety is the difference between the intrinsic value of a company and its current share price. This difference between value and price functions as a safety buffer, so that even if the company does not perform as well as you expected, you still have a big chance of making money, or at the very least, protection against major losses. The bigger the margin of safety, so the lower your purchase price is compared to the intrinsic value, the lower the risk you take and the higher your upside potential is. We discussed before that value investing allows you to minimize risk while maximizing returns, and the margin of safety principle is the reason why. Purchasing stocks at a large discount to intrinsic value minimizes downside risk, because much negativity is already priced in. It can't go much lower, while maximizing upside potential, since the purchase price is far below the estimated value of the company. This makes sense, doesn't it? A margin of safety is similar to pushing a ball on the water. The lower you push it, the more upward pressure builds up. If you buy low, it is harder to push it even lower because of this upward pressure. The biggest trick value investors have up their sleeve is therefore to make a conservative estimate of the intrinsic value of a company and then only buy when the stock trades at a price way below this value. A margin of safety allows you to make mistakes in your analyses and still make money. This is very important because it is impossible to predict the future with complete certainty. A conservative purchase price is your best protection against major losses. So how big should your margin of safety be? Well, let me give you the old cliché. It depends. It depends on how accurate you believe your intrinsic value estimate is, the return on investment you are aiming for, and how vulnerable the business is. You might feel fine driving a £9,500 truck over a bridge made to hold £10,000 when that bridge is just a couple of inches above the ground. But you might want a bigger margin of safety when that same bridge is above the Grand Canyon. I usually aim for a margin of safety between 50 and 100%, because it is better to be safe than sorry. Another way many investors try to limit their downside risk is by placing a so-called stop-loss order. What this does is quite simple. Let's say you buy a stock at $100 per share, but want to sell it if it drops too much. You can set a stop-loss limit of $80, for example. So when the stock drops from $100 to $80, it will sell the stock automatically, therefore protecting you from further losses. Sounds like a great system, but in fact it only gives you a false sense of security and actually limits your ability to average down. Let me explain. If you think a certain stock is a great buy at $100, it is an even better buy at $80, right? Because now you can get the same value for a lower price. If you purchase stocks at 100 and purchase some more at 80, your average purchase price will drop down to $90. This is called average down. Stop-loss orders limit your ability to average down, and therefore you should not use them. As a value investor, declining prices are your friend, because they allow you to buy more of a great company at even better prices. In other words, you make money when you buy, not when you sell. Lowering your average purchase price is a great way to increase your margin of safety, and therefore lowering your risk while increasing your upside potential. Because it is impossible to predict when a stock has reached its bottom, you should never buy a full position at once, but instead average down by buying more as prices decline. My final tip to minimize the risk of losing money is to only buy companies you understand, with a consistent track record of high profitability, smart decisions made by their management, and low debt levels. While history offers no guarantee for the future, these companies do offer you the best possible odds. To summarize, to reduce risk, we have to either reduce the probability of a loss or reduce the amount of money we can lose in a worst-case scenario. Diversification is the practice of spreading the risk over several investments instead of putting all your eggs in one basket. Diversification creates the illusion of a smoother ride by minimizing volatility. Limited diversification is good, and you should spread the risk of your portfolio by purchasing several companies, preferably in different industries. However, don't overdo it. Less is often more when it comes to diversification, so limit yourself to 10 great stocks or less. According to Warren Buffett, margin of safety are the 3 most important words in investing. Margin of safety is the difference between value and price and functions as a safety buffer, so that even if the company does not perform as well as you expected, you still have a big chance of making money, or at the very least, protection against major losses. A margin of safety is similar to pushing a ball on the water. The lower you push it, the more upward pressure builds up, and the harder it is to push it even lower. Stop-loss orders give you a false sense of security and limit your ability to average down, which is why you should not use them. As a value investor, declining prices are your friend, because they allow you to buy more of a great company at even better prices. It is impossible to know when a stock price has reached its bottom. Therefore, never buy a full position at once, but instead average down as prices decline. Only buy financially healthy companies which you understand. Stick to what you know. That was it for today's lesson. With this knowledge under your belt, you will be able to reduce your downside risk to a minimum. In the next lesson, we will discuss what financial statements are and why you should care. I hope you are enjoying this course so far and that you are learning a thing or two from it. If you have a second, please leave me an honest rating and review on Udemy. This will help the ranking of this course tremendously, so more people will be able to find out about it and improve their investment returns. Thanks, I really appreciate it.